Listen up, guys. If you are sitting there holding on to fintech stocks, praying that the Federal Reserve is going to magically slash interest rates to zero tomorrow, just to bail out your portfolio, you are going to get absolutely slaughtered. The mainstream media is out there feeding you this convenient, recycled garbage narrative that companies like Robinhood, rocket companies, and SoFi are dead money in a high-rate environment. They want you to panic sell. But I ran the numbers. I scraped the SEC filings using my own Python scripts. And I'm looking at the actual institutional order flows right now. Here is the crazy part. While retail investors are dumping their shares at a loss, the smart money, the hedge funds, and the institutions are quietly accumulating massive positions. They are setting a trap, and most of you are walking right into it. You need to stop trading on emotion and start looking at the mechanics of the market. Let's dive into the real facts, starting with Robinhood, ticker symbol HOOD. Everyone thinks Robinhood is just that meme stock casino from 2021 that died when the stimulus checks ran out. That is such a lazy amateur take. Look at their latest earnings. We are talking about a company pulling in over $470 million in net revenue in a single quarter, with transaction-based revenues jumping significantly. But the real meat on the bone here is their net interest revenue, which has been hovering around $250 million. Do you realize what that means? Robinhood is making an absolute killing off the cash you leave sitting in your account. The higher the Fed keeps rates, the more free money Robinhood prints, just by sweeping your uninvested cash into interest-bearing accounts. It is basically a license to print money, with zero customer acquisition cost on those specific dollars. But here is where the institutional intent gets really dark and fascinating. You have to understand payment for order flow, or PFOF. Think of PFOF like being a club promoter. You don't make the drinks, you don't own the building, but you get paid a massive kickback by the club owner because you bring the VIPs through the door. Robinhood routes your trades to market makers, and they get paid for it. Institutions love this because retail order flow is considered dumb money. It is predictable. When I am analyzing raw execution, data, and looking at the order management systems on the back end, I see exactly how much institutions value this non-toxic retail flow. Robinhood is currently rolling out gold subscriptions, matching IRA contributions, and capturing serious assets under custody, pushing well past $130 billion. They are shifting from a pure casino to a sticky, high-switching cost ecosystem. The big players know that once Robinhood locks in a user's retirement account, that user is never leaving. The street is pricing HOOD like a dying brokerage, but the smart money is valuing it as a next-generation asset-gathering machine. Now, you might be thinking, okay, Robinhood makes sense. But what about the real estate market? Mortgage rates are pushing 7%, so a company like rocket companies, ticker RKT, must be headed for bankruptcy, right? Wrong. This is where you have to look past the surface-level panic. Yes, originations, the business of making new loans, have taken a massive hit. Compared to the refinancing boom of 2020, Rocket's top-line revenue took a brutal beating. But here is the real kicker, that the financial news isn't explaining mortgage servicing rights, or MSRs. When Rocket originates a loan, they often sell the actual loan, but keep the right to service it. They collect the payments, handle the escrow, and for that, they get a fee. Think of MSRs like being a property manager. You don't own the apartment building, but you get a guaranteed cut of the rent every single month, just for dealing with the tenants. Here is the brilliant part. When interest rates go up, nobody refinances. That means those servicing portfolios last longer, making the MSRs infinitely more valuable. Rocket holds a massive MSR portfolio worth billions. While everyone is crying about nobody buying houses, Rocket is sitting on a cash-generating fortress that actually benefits from higher rates, staying higher for longer. Furthermore, Rocket has ruthlessly cut operational costs. They have slashed over $1 billion in expenses. The scenario playing out here is a classic cyclical bottom. The weak, undercapitalized mortgage brokers are getting wiped out right now. Rocket is just sitting there, hoarding cash, taking market share by default. When rates eventually do normalize even just a little, the pent-up demand for housing will unleash, and Rocket will have a total monopoly on the pipeline. The big money is buying RKT now when it looks the ugliest, because they know that in cyclical industries, you buy the blood and sell the boom. If you wait for the headlines to say, "Housing is back," you've already missed 100% run-up. If that doesn't make you rethink your entire portfolio strategy, wait until we look at what is happening with SOFI. Ticker SOFI is the ultimate battleground stock right now. You have people screaming that it's just a glorified student loan app. And you have others saying it's the AWS of Fintech. Let's look at the cold, hard math. SOFI finally crossed the line into GAAP profitability, posting net income positive quarters. Do you know how hard it is for a hyper-growth fintech to actually post a real, audited profit? Most of these companies just burn cash until they die. SOFI is pulling in over $600 million in adjusted net revenue per quarter. But the absolute game changer, the thing that separates SOFI from the garbage tier of fintech, is their national bank charter. Getting a bank charter is like transforming from a guy selling hot dogs out of a cart to owning a multi-story flagship restaurant in Times Square. Before the charter, SOFI had to rely on other banks to fund their loans, which meant they had to pay premium interest rates to borrow that money. Now they use member deposits. And guess what? Those deposits have skyrocketed past $21 billion. SOFI pays their users 4.6% on savings, which sounds high, but they turn around and lend that money out in personal loans at 12, 13, 14%. That spread the net interest margin is massive. The institutional money sees this. They see a company that is capturing the high-earning, not rich yet demographic. They're watching SOFI cross-sell products. A guy comes in for a student loan refinance, opens a checking account, buys some stocks on the Invest platform, and eventually gets a mortgage. The lifetime value of that customer is astronomical. But here is where the reality check comes in. I see so many of you holding these bags, emotionally attached to your entry prices. I bought SOFI at $20. If I just hold it for 5 years, I'll break even. Listen to me. The market does not care about your feelings. The market does not care what price you bought at. You need to strip away the emotion and look at the macro picture. We are in an environment where capital has a cost again. The days of zero interest rate policy, the ZIRP era, are dead and buried. Companies that cannot generate free cash flow are going to zero. Passive index funds are blindly allocating trillions of dollars into the top 5 megacap tech stocks, draining liquidity from the mid-cap and small-cap sectors. That is why companies like Hood, RKT, and SOFI have been suppressed. The algorithmic trading models are just shorting anything. That isn't AI or big tech. So what's the bottom line? How do you actually play this without getting chopped to pieces? You need to stop trying to catch falling knives based on Twitter hype and start trading like an institution. For Robinhood, you are watching the AUC assets under custody. As long as that number keeps climbing, the underlying machine is healthy. For Rocket, you are watching the MSR, valuations, and their market share in purchase originations. If they keep taking market share while the overall pie shrinks, they will be unstoppable when the pie expands. For SOFI, it is all about deposit growth and maintaining GAAP profitability. If they can prove they can print money in a hostile macro environment, the multiple expansion on that stock will be violent. The gap between the prepared investor and the clueless gambler has never been wider. The people who are doing the homework, looking at the balance sheets, and understanding the macro plumbing are positioning themselves for generational wealth. The people who are just blindly holding and praying are going to get washed out. It is that simple. You have to take control of your execution strategy. If this deep dive actually helped you see the market clearly today, smash that like button. If you have specific stocks in your portfolio that are keeping you up at night, or some economic news that makes no sense, drop it in the comments below. I will personally run the data, do the fact-checking, and bring the raw truth in the next video. Make sure you are subscribed, stay disciplined, and let's get rich together.